Hi there, welcome to Funding by Alex. My name is Alex, and today I would like to talk to you whether your business is VC suitable. So, got a lot of questions from people who were looking for my help to raise funds. Some of these guys actually had VC ready or companies that actually were interesting for VCs, and others had more what we call cash flow businesses, which are more conventional businesses. There's no good or bad here, it's just different and it needs a different solution. So, for the VC route, I'm going to explain what, and after that, I'm going to touch on what cash flow businesses need. So, basically, every startup starts with an idea and then a team to carry out the idea. So, the idea is actually the horse, the team is the jockey. The jockey is actually driving the horse forward. The way venture capital funds are looking at it is that the horse is maybe 10, 20%, and the jockey is 80 to 90% of the entire equation. So the reason for that is that you can always change the horse, meaning the horse is actually the idea. So you can pivot to another idea, meaning you change to another idea that you are going to carry out with the same team. If your team is very capable, but the idea is just not clicking, then it's easier to put that team on another idea rather than having a good idea, but the team is not able to carry it out. Then to change the team midway is actually something that it's very cumbersome to find the right connection, the right click. There are various companies that had very good ideas, but maybe the team was not able to carry it out. And the other way around, there are also several teams that maybe have gone through 4 or 5 iterations of an idea, pivoted 4 or 5 times, and still haven't clicked because, yeah, the idea simply doesn't click for them. So that doesn't mean that these guys are bad founders or they are unable to do it, but just waiting for the right idea. So you have very capable people waiting for the right horse. Now, that's, like I said, 10, 20% of the equation. So what do you need basically to validate an idea? So it's actually product market fit, which means that you have proven that, for example, you're launching a new product or a new service, that there is demand, there's sustainable demand. From the very first moment you have traction. Traction means that people are interested in the idea, people are buying, people are paying for whatever you are offering, and which this you can actually create a proof of concept. It's usually small test. Basically, it's like a market test you are carrying out, which you use what they call pre-seed funding. So you have seed funding, which is you put a seed in the ground basically and you watch it grow. But pre-seed meaning like, okay, to get to the seed, to get the right seed is actually the proof of concept. I would classify as a seed that you are trying to engineer with your team. And sometimes an idea that was on paper, you maybe forgot something, or in practice people are looking at it differently and it needs to be tweaked a bit. It's not like completely different idea, but you need to tweak it and you need to change it a little bit in order to make it fit. So as soon as you have this product market fit and that proof of concept that you have proven that it works, you need to look at various other things. And this is, of course, not in the necessarily in the order I put it, but before you actually start with anything, you need to see whether the niche you are playing in, so the solution you have thought of a problem. Usually, startups actually start with a problem that you create a solution for. Anything that is a problem is a potential startup because there is a solution for that problem that you can think of. Maybe it's not a foolproof solution or not a complete solution, but it's actually a niche that you need to identify, or the market that you need to identify, whether it is big enough. So if you are solving something that has only a few users, so like a very small number of people, very small number of companies that actually are going to use it, so B2C or B2B, business to consumer or business to business, then it's not big enough and maybe it's not investable. So that also is a box that you need to tick. Now, venture capital funds are usually more interested in B2B rather than B2C. It's not a given, not 100%, but you have to imagine that for us, like as a layman, we would basically come up with an idea, and most likely it will be a consumer focused idea because We are consumers. We are looking at things that consumers are encountering, and a consumer product actually needs marketing, needs a lot of investment in order to bring to market. It's a lot of investment in advertising as well. If you look at business to business, it's actually less obvious, more boring, but and boring maybe not for everybody, but I mean, for us consumer focused people, it's maybe more boring. So people are not thinking about, oh, what kind of problems do companies have, and what kind of solution can I think of to actually alleviate that problem. Now, that is the thing that you need to think about before you start. Okay, where am I playing? Is it a business to consumer side? There's a lot of venture capital funds that are really not interested in that. There are some that are specializing in it, of course, but then they have synergy in a portfolio that normally fits with it. So you have to imagine that when you are approaching a fund, you have to look at two things. The first thing is whether they have already something similar in their portfolio. Normally, it prevents them from, backing the second horse. There are several examples. Yeah, where you used to have SoftBank in from Japan that would bet on a number of players, would take a stake in all of the players basically, and hope that if you have all the horses in the race that you are backing, that automatically you win because you back all the horses. But yeah, in the end, they've also deviated from that strategy now by it just cost too much money. It was just too many losses basically were made on that part. There's a couple of other things that happened there, of course, but that was one of the companies that really did that rather than backing one horse and hoping for the best. Yeah. So, but the second thing is whether the portfolio connects to it. So there's a lot of, oh, this is a venture capital fund. Let me send my pitch deck, but maybe they're completely not playing in your niche. That is one of the things that you need to keep in mind. If you have something that is completely not connecting to anything else in their portfolio, if their portfolio is very tech heavy and deep tech heavy, you shouldn't come up with something that is maybe in the food and beverage area or consumer based area if they have a lot of business to business things in their portfolio. So normally they would like to take something in their portfolio that connects to the others potentially. Yeah. So in the end, you say, oh, okay, this is missing. Then we can actually get synergies when we are combining startup A, B, and C. B can buy from A and C can buy from A. Now, and then you have another, ready-made customer base where they can help you scale it basically. So rather than that, they try to create this ecosystem in their portfolio. Now, that's the things that you need to look for in that sense. And they will always look at whether the market or the niche, yeah, like it's better to maybe dominate a niche than play in a very big market and be a very insignificant player, whether that is worth it, whether they can actually get 5 or 10 times their money back invested. So if they get in early stage. Now, then, of course, one of the key components of any startup, which sets it apart from any cash flow business, basically, is that you have an opportunity to disrupt by applying technology. So technology is not an objective in itself; it is an enabler for startups to leverage that technology and do something that, let's say, in the conventional businesses that they are competing with, because you're always competing with conventional business that you are disrupting. So people who have done it for 20, 30 years have entrenched themselves in, maybe longer even, but entrenched themselves in the market, and you are actually trying to muscle in as a new kid on the block with technology to do things faster, better, cheaper, whatever the edge is basically. But the technology has to make it happen basically, which conventional companies sometimes they can adopt it, but in the end, conventional companies have done it for a long time like that, and they are usually a bit slower to change and slower to adopt new processes, because what worked, if it ain't broke, don't fix it. That's the age old the age old thing that you say. In essence, then scalability and ability to capture a share of the market. So let's say you have an investable idea that is not scalable, or have an idea that is not scalable, then it's not investable. So that's what I mean. So it needs to be scalable. You need to be able to make it bigger by applying this technology, applying resources, deploying resources, and you need to have a reasonable amount of a reasonable chance to actually capture the market, capture a share of the market. So they say, okay, this market is 1 billion. I'm going to capture 900 million of it. That's not realistic. But let's say you are looking for, within the next 2 years, you're looking for 10% of the market. Now, that's more of a thing to aim for. And this is how I'm going to do it. So these are the plans that you need to present to investors. And they need to have an idea that, the plan you created, and not just, oh, this is a big market, therefore I'm going to capture it. No, how are you going to do it? That's actually the step-by-step plan. So with the end in mind, okay, I'm aiming for 10%. What needs to happen in order to capture that? And last but not least, this is something that is not always as obvious, but what every investor is looking for is a hockey stick growth potential. This is again very much based in tech. So what it means is actually that the growth is actually going like this. So you are having this hockey stick at the end, which actually means, in layman's terms, normal plain English, basically, is that with the same resources or without actually additional investment, you can actually grow like that. And this growth is actually exponential without additional investment, without actually deploying more resources, more costs, etc. Normally, when you look at ideas that actually don't tick this box, for example, is that, okay, I need more people. I need to put an army of salespeople on the road in order to get to to here on the scale where I'm here. And what they want to see is actually that you are going to grow without investing much more resources or much more human resources in that case. So that's the hockey stick growth potential. Then we come to the jockey. So what are investable people? So investable people need to tick a few boxes. It's not that it's set in stone, chiseled in stone. Basically, it's actually something that, if you tick all the boxes, you have a reasonable chance to make the cut. So you have to have good education. So bachelor, master's degree, maybe a doctorate. Basically, that's the bare minimum, I would say. In essence, is a bachelor's degree in order to have a chance. Usually, it's a master's degree from a prestigious university. Actually, will help you connect to more people in venture capital funds. So they are looking really at, did you have good professors, did do you have a good network also from, because I would say the quality of a Harvard education, of course, is very high, but the main thing that a Harvard education will give you is a network of other Harvard graduates who are going to go to all these other companies that you can network with. Usually that's where people are still in awe. Oh, I have a Harvard MBA and I'm going to lead this company. So that's actually a very big plus for founders. Um, then work experience. If you just graduated from Harvard and you are starting your startup, that's still going to be a very much of a long shot, but you've ticked one of the boxes, and then the next thing is work experience. So that is, someone who is young. Startups normally have that image here, like young people creating something out of college, and the idea flies, etc. Well, that's usually when the idea is clicking, when the traction is there. But with work experience means like, okay, I know how to run a company. I know, I've done the hard work. I know how to roll up my sleeves and do it, basically. So all these things are very important to work to put aside. So if you look at education and work experience, like I said, it's not like only people from Harvard with 5 or 10 years of work experience in a C-level role actually are able to make it. But you know it can also be that you have relevant work if you are doing something, for example, that solves problems for supermarkets, and you have worked in a supermarket as an operational manager, like a mid-level manager, or even in a more junior role. That is already relevant experience in the industry. So relevant experience in the industry is actually something that is maybe more important than the uh, 2 points above, because I've seen people that don't have a Harvard MBA, that don't have work experience in C-level roles, that they actually propel themselves because of the idea that clicked, and they've just taught themselves taught themselves the ropes. And having said that, I have also worked in startups myself, where the balance between people that were theoretical, so you have um, management consulting background, where people were very good at the strategy side of things, but the execution was not enough. There was not enough people who actually could do the execution. So um, this balance needs to be there. There need to be people that, in different stages of the startup, you need different people. Sometimes the CEO who starts out, for example, is someone who will not make it after a couple of years, because the the problem is that they need a different type of CEO to do the next step. So to grow from 1 to 2, this guy was the right guy, but from 2 to 10, they need someone else to do it, because it's less hands-on. They need more interaction with maybe the investors. They need to reorganize things. Maybe this CEO, I've worked with a guy who was very good in the very early stages, and we saw he was actually drowning a bit when the company became bigger. And unfortunately, that for him, he was sidelined because of that reason, basically. So um, then experience as a founder with exit. So if you look at founders, who have already done it, so that is normally, okay, I'm starting a new startup, but I've already successfully exited from one startup. That's a very good point. And you need to have a very complementary team. So you, as a CEO, you don't need to have everything under your belt. You can have a complementary team of people with the relevant experience. So it's actually more the package. And if you don't have, all these people are very young, maybe very early in their career, basically, all young go-getters, basically. Um, then having more experienced advisors is another thing. Do keep in mind, though, if there are advisors on your pitch deck and these advisors haven't invested in your company, so just for advisory shares, then that's usually a red flag for venture capital funds as well. So, okay, why is this investor there? Why is this advisor there? If he hasn't invested a cent in your idea, because does he not believe in it? Is it just you using his name on the deck to look more significant? So, that's normally the thing to keep in mind. So, not all businesses are VC material. So, you're looking for strategic investors or bank financing if you are running a cash flow business. So in essence, a cash flow business is something that is like I want to open a store, I want to open a beauty salon, I want to open something that is not scalable unless I add more people. So that's actually the way a cash flow business is put aside. Can be very healthy. I'm not saying it's bad or anything like that, but the predictability of it is basically what makes it a cash flow business. And that's the weird thing, actually. We're looking at investors. They are, you have investors with a very strong risk tolerance. So they are people who would like to, okay, if I invest $10,000 in your company, am I going to get 1 million back because at some point there's an exit? Basically, that's the sort of upskill of upside potential that they're looking for. There are also people who say, okay, I'm fine if I invest 10,000, I get 15,000 back at the end of the year, for example, or 20,000 next year. So in the end, they're looking at a yield for their like a low risk. So this is more for cash flow business, and why banks also are usually the safest. They have a very high risk profile. Sorry, very low tolerance for risk. Or banks really are still the cheapest source for capital, but normally this risk profile is actually limiting you from, they want to have everything sorted out. There's just, very few defaults on loans, basically. And the upside potential, like I said, is more for venture capital funds, because, okay, I'm betting on 10 horses. Maybe 8 of them are going bust. 2 of them make it, and they actually pay for everything else plus, my 5 or 10x or return on capital. So there's normally a bet on multiple horses. And banks don't do that. They actually, and more conservative investors don't do that. So you have these people who would like to buy and sell. Okay, I'm giving you $10,000. I actually need back 15,000 in a year. Okay, that's a 50% markup basically. Now, then that sort of thing is more for cash flow businesses, and these investors exist. These investors are there. They are not the sophisticated investors, as they say it, but they just want to have some yield on their investment basically. So they are looking at it from a different perspective, and I think um, I'm not saying not that they're not sophisticated, but I mean, if you look at investors, everybody has a mix between high risk and low risk in their portfolio, basically. So this is the stuff that you can look for, in your network. Strategic investors are people that could be customers, could be suppliers, friends, family, people who are having a strategic interest in the business, basically. That usually is on the supplier or retail, or it could be even a competitor that is interested in this. So I'm basically advising you to explore these opportunities. Thanks for watching. I hope you liked it. If you did, please like and subscribe. And please feel free to email me at alex@goldendragoncapital.co if you have any questions. Hope to see you in the next video. Thank you. Bye bye.